Why is it that so many people prefer to buy a $1,000 iPhone instead of buying a cheaper smartphone that does basically the same thing? Why is YouTube pretty much the only popular video platform that everyone uses? Why do most companies and individuals in graphic design continue to use Adobe software even when other software is cheaper? The answer is that these companies have what Warren Buffett would call an economic moat. We all have brands and companies that we are loyal to. Whether you like it or not, price usually isn't the most important thing when you're doing business with these companies. So, what is an economic moat? And what does it have to do with picking stocks? When Warren Buffett uses the term moat, he is talking about the moat that protects a castle from invaders on the outside. With this moat, it is much harder for invaders to break into the castle. Warren Buffett thinks of the castle as a business, and it is their job to build the deepest and widest moat to protect themselves against invading competition. Based on economics, in a perfectly competitive market, customers like you and I would only pay the lowest price for a good or service, and therefore only buy from the company with the lowest prices. If the world were actually like this, it would be very hard, if not impossible, for a company to make any profit. Think about the stock market. If you try to sell a stock, no one is going to buy your stock if you are selling at a higher price than someone else. However, the world is not perfect, and people often spend more than they have to for a product or service. They spend more even when there is a similar and less expensive product at another company. The company that can sell at a higher price than others for basically the same product is said to have an economic moat. One of Warren Buffett's principles of investing is that he likes to only invest in companies that have an economic moat. He looks for companies that can make more profit than the competition on similar products. If a company can make a product for the same price as the competition and charge more for it, they will have larger profits. Therefore, an economic moat allows companies to have bigger and more long-term profits than the competition. Think about it. If you have an iPhone, what would it take for you to change to a different smartphone? Another thought. How much more would you pay for a Supreme sweater or a Louis Vuitton handbag? If you're like most people, these brands are much more valuable than cheaper versions of the same products, and you would likely spend much more money on them. So, basically, an economic moat helps businesses protect their profits for a long time. But how does an investor find out which companies have economic moats? For my personal investments, I can say that Morningstar's definitions of economic moats give just about every moat to look out for. So, I'll go through and give an example for 5 types of moats a company can have. The first type of moat a company can have is called the networking effect. If you've ever heard of the term positive feedback loop, the networking effect is just that. As more people use the product or service, the product or service gets more valuable. And as it gets more valuable, more people use the product or service, and on and on and on. Some examples of the networking effect include almost all large social media platforms. YouTube was not that valuable with only a few content creators on it, but as many more people started to make videos, more people came to watch, and well, you know the story. Same goes with Facebook. Less people wanted to join when most of their friends weren't on the site, but when people they knew started to join Facebook, well, let's just say Facebook grew exponentially. These companies run ads, and the more people that join a site, the more ads you can run, and the more money advertisers will spend. So yes, networking effect. If you can catch it early or in the growth phase, you may have found yourself an investment that will lead to an early retirement. The second type of economic moat to look for is called intangible assets, or more simply, a company's brands or patents. Brands and patents let a company have a distinctly different product than the competition. Therefore, competition can have a hard time taking customers away from a company that is the only one that can make a product. Back to the Supreme example, Supreme has created a brand where they can charge much more money for a sweater than many other companies sell. Many other companies sell the same sweater with the same fabric and measurements at a fraction of the cost of what Supreme charges. However, that infamous word Supreme allows them to add many more zeros to the price tag. And even more importantly, legally, only Supreme can produce a sweater with their brand on it. So competitors cannot just recreate the exact same product to sell, legally, that is. Pharmaceutical companies also have this type of economic moat. They can charge as much as the government allows them to for patented medications, and customers will definitely pay. Other companies cannot legally produce the same drug for a certain number of years. So, they have some of the largest moats any company can have. And of course, that's why the government steps in to regulate prices. The third type of economic moat a company can have is called cost advantage. This type of moat has a lot to do with the size and power of a company. The bigger and more powerful a company is, the more it can bargain with suppliers for the price of a product. For example, Walmart almost always has lower prices on the same products that you can find at a small business. This is because Walmart is so big that they can bargain with the companies who supply the product. They can basically force these suppliers to give Walmart the lowest price possible. This is why Walmart can offer such low prices compared to many smaller stores. Walmart decides how much they buy the products for, not the company selling it to them. A company with a cost advantage moat is protected from smaller companies and has a huge bargaining power with suppliers of products. The lower Walmart's prices, the more people go there to shop. The more people that go there to shop, the more suppliers want their products in Walmart stores. So, they give Walmart a steep discount in return. The cost advantage moat exists in many different companies, so keep an eye out, especially for large retailers and distributors. The fourth type of economic moat is called switching costs. This moat exists when a company's product is too complicated, expensive, or inconvenient to switch from. So, it just makes more sense for the customer to stay with that company even if it costs more money. The best example of the switching cost moat is Adobe. Adobe's software is extremely complex and has many different programs a person or company must learn. Once these programs are learned, it is rarely worth the money or effort to switch to another company's software, even if it does the same thing and costs less. Another example of this type of moat can be seen in Apple. For the past decade, Apple has been working hard to create what's called the Apple ecosystem. Once someone has learned iOS or Mac OS, they probably will not switch to another phone or computer, even if it is cheaper. This is because it is much more inconvenient to switch than it is to just stay within the Apple ecosystem they already know. The last type of economic moat is called efficient scale. Efficient scale happens when a company has made a significant investment in an industry and can charge less money for products than the competition and still make a profit in the end. Basically, a company has spent a lot of money so that they can produce a lot more products and charge a lower price than a new company entering the market. This situation is often referred to as economies of scale. In addition, the efficient scale moat can also mean that the company has spent so much money building a product or service that no other company can produce the same product and make a profit. For example, many energy, railroad, and telecommunications companies have efficient scale moats. Most electricity companies have such a large and expensive power grid that if another company wanted to build a power grid in the same locations, they wouldn't make a profit. The same situation happens with railroad construction and telecommunications providers. If you decide to invest in a company with this type of moat, you can be sure that your main concern as an investor is the government's regulation of pricing instead of external competition. Owning an entire power grid is like owning a prescription drug that never loses its patent. Competition is virtually non-existent. It is important to consider whether or not a company has an economic moat before investing. If it does not have an economic moat, what's to stop invading competitors from coming in and burning the company's castle to the ground? If you are an investor who searches near and far for low-risk, high-return investments, be sure that your investments have moats to protect your great companies from attacks. Even better, look for companies that are growing their economic moats by building up their own moats or buying other businesses that have great moats. Warren Buffett has a history of investing in companies with strong economic moats, and he has said over and over that successful investors should prioritize searching for moats and only invest in companies that have them. With all this in mind, Warren Buffett's own words describe it best. What we're trying to do is find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. Thank you so much for watching. In the next video, I'll explain how to find an honest lord in charge of the castle. Please like and subscribe if you enjoyed, and I'll see you again next time.